Hello, everybody. Welcome back to the Abundant Investor Tip of the Day. I'm Shelley Hagen, and I'm here today to share with you another tax tip. I shared one before Christmas, and I have another one here, just a brief one. I want to talk to you today about commingling funds. And I've mentioned it before about how to document when you're taking in money and moving money around, and it's really important. So I do want to talk a little bit further about that. I'm going to share some information with you on my screen that will hopefully help in facilitating this discussion. Anyway, when I set up with my mentor students and the training that I typically do, we talk about a three-tier structure where we have a holding company that we own as shareholders. And then that holding company owns a management company where we do our active income, such as fix and flips and wholesale, etc. And we have a real estate company, which we actually hold the real estate assets in. So the rentals and the actual property when you're doing a rent to own. I'm going to talk today about how to move the money back and forth a little bit amongst there. So if I'm lending money to the holding company, that would be a shareholder loan or a director loan because I'm a director of the holding company. But if you notice on this diagram, the holding company is the owner 100% of the real estate company and of the management company. So if I lend money down here to the real estate company because I want to buy a new property and I have the money for the down payment, that would be a director loan. All of that needs to be documented. I've talked about that in the past in other tips. It's when you start to move money back and forth between the two companies, the management company and the real estate company, that you run into the issue of commingling, because those are separate entities on their own. They're owned by the same mother company, but they're not owned together. So if I'm going to lend money from my management company, say I did a fix and flip and I made $50,000 and I wanted to use it for a down payment on a new rental, I could lend it over here. However, I really shouldn't be doing that. I could take the money back to the holding company, lend it out of the holding company, that's fine, because it was a shareholder loan repayment back to the holding company perhaps, or it could be dividends that I'm paying there. But when I'm loaning back and forth between the two corporations, those are funds that are supposed to be separate to those two companies. Now, this does apply for both Canada and the United States. So CRA and IRS both have similar laws, but different. So you definitely need to talk to an accountant or a tax attorney so that you have a good appreciation of what you're doing here when you're moving this money back and forth. If I'm going to lend that money, I have to document it. Technically, I've been told by my accountant I should be charging interest between those two companies. And so when I go to pay it back, then it's a repayment of a loan, not a director loan, but a loan to that company. So talk to your accountant about it. You do want to be careful about this. And the other issue that I want to bring up, because we talk a lot about using other people's money, OPM investors' money, could be RSPs, or it could be their Roth IRA for those in the United States, or cash, whatever it happens to be. Either way, when you take that money into your company, say you were borrowing money into your real estate company and you told the investors you were going to use that money to buy a rental property, and then you change your mind and go, oh, I got this really good deal on this fix and flip property. Let's take that money and move it over to the management company and use it there instead. Well, you're not supposed to do that. You really should be careful of that because you've made a contractual agreement with those investors that you were going to use it in the real estate company. Now you're going to get yourself in trouble. And if you're ever audited, the Revenue Canada and IRS are going to wonder, where'd that money come from all of a sudden, and where's the documentation behind that? And again, the contract needs to go with the corporation that it contractually agreed to loan the money to. So you can get yourself in a lot of trouble. I had gotten in an investment in Canada a number of years back where we had invested a bunch of money, and the group that had set this investment up had set up a friends, family, and close business associate investment corp. Well, all of a sudden the money disappeared. and the investors were all inquiring, where's my money? I got some properties, but I didn't get all the properties I was supposed to. There were some issues that came about. So finally we ended up starting a litigation. And through the audit, we found out that they were commingling the funds. They had taken the money that had come in from investors and they were actually spending it for their personal use, not investing in real estate. And at the same time, he was running a office that was doing accounting and bookkeeping for people. And he started running all of his business activities through that same investment account. Well, that is absolutely illegal. Not supposed to do that. It was set up under the Securities Act. So needless to say, that litigation did not go very well for them. So the reason for the tip of the day is just to make sure that you're conscious of it. You might be just getting started. You may have done this and not even realize what you're doing, but have some good discussion with your accountant or tax attorney to make sure that you're setting yourself up to be successful and not something that could come back and haunt you again later on. So with that, I'm going to leave it for today. So that was my tax tip of the day, and we will be back again. Have an abundant week and all the best. Happy investing.